Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Fed Chair Jay Powell speaks at Jackson Hole, Wyoming, and when he speaks, the stock market listens. President Biden is forgiving up to $20,000 in student debt, and Tesla splits their shares 3-for-1. We've got that and more tonight on this Friday, August 26th, 2022. Hi, I'm Andre Laborde, and welcome to Wall Street Wrap-Up on this Friday, August the 26th, 2022. I hope your week went well. We've got a great show for you tonight. Glad you could join us. The chairman of the Federal Reserve gave a brief 5-minute speech this morning in Jackson Hole, Wyoming, but that was all it took to get his point across. Chairman Jerome Powell said rates are going to stay high and go possibly even higher, whatever it takes to get inflation under control. Well, this sent all the sectors in the S&P down for the day. And a little bit of history. Since 1940, the United States has experienced 9 times when inflation rose higher than 5%. Now, presently, the country, as of last month, has an 8.5% inflation rate. Now, all prior 9 times since 1940, a recession followed this higher than 5% inflation rate. Well, as you can see from the chart, in 1945, right after World War II, all the way to the last time in 2007, never has inflation rose over 5% since 1940 that a recession has not occurred. Well, will this year be any different? Only time will tell, but, as Mark Twain one time famously said, history may not repeat itself, but it sure does rhyme a lot. Well, and there's a reason why a car, the windshield is much bigger than the rearview mirror. It's much better to look ahead as to where we're going, but by seeing where we came from through the rearview mirror, one can help navigate the rocky road ahead. Coming up on the show, we'll be talking with Terry Dufresne. Terry is head of investments and managing director at J.P. Morgan's Private Bank. We'll ask him where he advises his clients where to put their money during these possible volatile times ahead. Terry's going to be with us in just a moment. And President Joe Biden this week will be forgiving up to $20,000 for students with Pell Grants and up to $10,000 for all other student borrowers. Now, this is for any student debts for those making under $125,000 per year for individuals and for those making under $250,000 a year for couples. Well, how did the markets do this week? All the major indexes were down, with major sell-offs occurring today. And this week, the Dow Jones ended at 32,282. That was down almost 4.25% for the week. And the S&P 500, they closed at 4,057. That was down just over 4% for the week. And finally, the NASDAQ, they ended the week at 12,141. That was down 4.4% for the week. And stock splits were announced this week, including the board of directors at Palo Alto Networks announced a 3-for-1 stock split. Now, that stock ended the week at $560.69, and Tesla has split their stock yesterday on Thursday for a 3-for-1 stock split, and it ended on Friday at $288.09 a share, with adjusted for this split. Well, let's get to our guest this evening. Terry Dufresne is head of investing and managing director at J.P. Morgan's Private Bank. And best of all, he's here with us tonight. Hi, Terry. Welcome to Wall Street Wrap-Up.
Thanks, Andre. Great to be here.
Terry, for the last month or so, and even into the beginning of August, the stock market's been doing great. And then for the last week, about the last 7 to 10 days, it's been taking, I'll use the term taking a breather, or it's been fluctuating. What is this just taking a breather right now, or do you think we're in for some worse times ahead?
Yeah, it's had quite a bounce there, Andre, ever since we've had that real nice rebound off that June low. And that was in response to a lot of things, including most of them, the thought that the Fed may be indicating that they're going to start maybe hitting the pause button, or maybe perhaps even, having a little bit less of a rate increase. Because as you remember, they've done 2 75 basis point rate increases in a row. They took a break, a breather in August, and they meet again in September. And what the market's trying to parse is just that all the data that's coming through right now is that where is the economy and how hot is inflation? And now we're starting to see some signs that inflation may have slowed a bit from the very hot 9+ number that we got for the month of July, that was reported earlier this month in August. And the thought is that maybe the Fed has done some of the work they were supposed to do by slowing the economy down, and that's why you saw the market have as good a return as it did off the June lows. Now you've had some Fed speakers do some public engagements where they've had some commentary around not so fast. We need to get more data in as to whether the economy has slowed enough and inflation numbers have come down enough to make it worth our while to maybe think about altering interest rate policy here at the next Fed meeting. And that's what the market's digesting right now. And I would tell you the last few days has probably leaned a bit more into the Fed probably having even more of a hawkish stance that they've done before. In other words, leaning into the 75 basis point rate increase in the September meeting, because again, I don't think the Fed thinks this job is done.
Now, you're talking about waiting for data to come in. Now, this week, the housing market has been releasing data with pending home sales, new home sales, and such, and they've been dropping bad. Now, with the data such as this, will this make you think that maybe in the September meeting of the Federal Reserve, they may lower interest rates with data like you're talking about?
No. What I think is happening there, Andre, you're clearly seeing the signs of what the Fed intends to do, which is to slow down the economy. And one of the biggest components of the U.S. economy is the housing market. There's various studies that show that for every time you have a house, every dollar you spend on that, there's some additional knock-on effects that multiplies that dollar because you're buying furniture, you're paying the house, you're replacing the carpets and the drapes. All those things together add up to additional spending. And when they raised rates beginning earlier this year to where now the 30-year mortgages are still well over 5%, not as much as 6% as they were back in June, but still much higher than they were a year ago. That is slowing down the housing sector. And the reports you're mentioning earlier is that there's been any number of reports, including new home sales, used home sales, all have been trending down significantly. And the one that we got earlier this week was probably one of the lowest I think we've seen in several years. So the effects are happening where the Fed is having an effect on the housing market in particular, slowing that activity down. But no, it's not enough to make them even think about adjusting rate policy.
In September, when they do meet, do you think that they're going to continue with another 75 basis points, or do you think it'll be higher or lower?
Yep, not likely higher. I think that they're still in this kind of campaign of shock and awe, where they want to surprise the markets. The first one definitely was a surprise that we had. The second one, not so much. And that's why I said earlier is that there were maybe some pundits out there thinking that the next move may not be as high, maybe only 50 basis points or half a point instead of 75 basis points. I think that right now I would still plan on another 75 basis point rate increase because, again, it's going to be very data dependent. We'll hear some later, about what Jerome Powell is thinking about the kind of data that keeps coming in as to whether inflation has cooled off or not. But from where I sit today, I think that we would probably still expect a 75 basis point rate increase in September.
This week, Neil Kashkarian, who is the federal governor of I think Minneapolis.
Minneapolis, yep.
Yeah, he was saying, and he is known as one of the more dovish type of Federal Reserve governors. He came out this week was saying that we've got to keep, like you just said, keep the gas going as far as I'm talking about keeping the rates higher to be able to slow down the rate of inflation. So I think what you're saying is an accurate point.
Yeah, he has been, as you've already pointed out, one of the more dovish, and it's notable how much he has become a lot more hawkish and vocally. Because he is on to be on record that he does think that there is some more room to go, or definitely some more moves to make from the Federal Reserve to slow this economy down. I mean, we haven't yet mentioned this yet, but if you think about it, Andre, is that this economy, for whether we are in a recession or not, we can debate that till Sunday, but this is probably one of the more unusual periods of time in history where You'd think that by the way that the economy is measured, that we are in a recession because you've had now one, not but two quarters in a row you've had negative GDP. But you step back and say lowest unemployment rate in decades. You're also seeing some very, very strong balance sheets for both consumers and also for the corporations. Earnings have come in pretty good for the second quarter, actually probably a lot better than people expected. And of course, there's still a lot of spending going on. There's still that mountain of cash that consumers built up, during COVID, where they didn't necessarily spend it. It's not as high as it used to be, but there's still, a good bit of money sitting on the sideline waiting to be deployed.
At one time, there was what's called quantitative easing. In addition to almost zero interest rates,
right,
they were also buying bonds, and I'm talking about the Federal Reserve.
Yes.
So they were dumping money into the system, and it wasn't that long ago when they stopped buying bonds and throwing more money into the system. They're now starting to trying to take the money out. Do you think they should accelerate that to take more money out of the system?
Right. So instead of doing quantitative easing, doing quantitative tightening, and that would be where they're actively, selling part of their portfolio, or even not reinvesting some of the proceeds from either maturities or from some of the coupon payments. And as you know, once they do that, that takes the effect of tightening the supply, and of course, once you reduce supply, demand's there, so it raises the level of interest rates. So yeah, they're doing that in addition to raising interest rates on the policy.
Terry, you brought up a point a little bit earlier about how results are coming in from the second quarter. We're now into the third quarter, and results are coming in from stock from the second quarter. And for the most part, and you're right, they're pretty good.
Yeah.
That of the few misses that they're having more making their estimates than those that are not. What are your thoughts that with inflation the way they are, there are many businesses that had to raise prices to keep up with their suppliers, with their production staff and such. Do you think that when they came out with these numbers that they're coming out now with, is it because they're selling more goods and services? Or do you think it's because they had to raise prices to keep up with inflation, that maybe they may not be selling the same amount of goods and services, but it has a look of a better than the second quarter of 2021, or better than the first quarter of 2022?
Right. Yeah. So there's a couple of ways you can look at that, Andre, and that is that top line sales have increased, and a lot of that was due to some of the price increases that a lot of these companies were able to pass on to the end user, to the customer, and they had to do that because, as you've already pointed out, they're paying more for their supplies. But they're also paying more. They're also paying their workers more, and lots of times, some of these companies have absorbed some of that in their margins. So they didn't necessarily always find its way down the bottom line, but still, it's been better than it did the previous quarters. Of interesting note, though, is that you really need to separate out service providers from goods providers. And as recently as this week, there were a couple of retailers that reported their earnings, and they did note that they did have some fairly good sales, but they are cautioning in the future. And that's because they've had inventory bills. In other words, they've had a lot of goods sitting on the shelf that has not yet been sold because they bought a lot of these supplies in anticipation of the consumer still being a very active buyer. Well, we all know what happened, particularly during the summertime, is that we went from being a goods consumer to a experiences consumer. So I may have already replaced my big screen TV, right? But I've yet to take that trip to Disney World. And so I'm going to be doing that instead of maybe buying another TV, which I don't necessarily need.
Yeah. When those people, as you were talking about, taking that trip somewhere, many people who have to use a car, the price of gas has been going up. And OPEC they're having the next OPEC meeting, I think, on September the 5th, and the OPEC and OPEC Plus. And although Saudi Arabia didn't actually state it specifically, they kind of hinted that they're not going to be increasing production. If anything, they're going to either stay the way it is or might even cut back some. Now, on the world market with Brent and such, what type of an effect, as far as, let's say, the United States, do you think that'll affect with our economy if they do cut back on oil?
Well, their intent is to keep prices high because they, meaning OPEC Plus, definitely benefits from higher energy prices. And I think there was a news report earlier, maybe this week, even last week, that Saudi Arabia once more is flush. The coffers are flush from all the sales, and of course they're using that to go ahead and spend much more on their economy and on their people too. So I think that you are going to see energy prices still remain high as to where they are right now. An odd thing that happened though is, Andre, is that gas prices did come down, and there's an old adage about what's the best cure for inflation is inflation. Mm-hmm. And when you saw the average price of unleaded gasoline top $5 a gallon earlier this year, that literally was a tipping point where demand really fell off significantly. And there's a bunch of studies that shows there's a lot less cars on the road because they were responding to higher gasoline prices. Now you've got gasoline prices, averaging back down in the low fours, so it's come down quite a bit. And the thought is that that's probably a nice equilibrium price, for a nice clearing price for people can continue to drive and not pay so much for it. But overall, higher energy prices are a drag on our economy because it is a cost that's borne by a lot of our consumers, a lot of our citizens within the United States.
The Biden administration is taking oil from our strategic petroleum reserves to use to put that into the economy. Mm-hmm. Well, I kind of equate that, let's say you've got a household budget, and at the end of every month you've got some extra money left over. Well, every month you're taking that money out of your savings account. Well, the reason it's not that you've got extra money now in your household budget coming from another source, you're getting it from your savings account. Do you think that, sooner or later we're going to have to replace the oil from the Strategic Petroleum Reserve? Do you think that we're just kicking the can down the path for a larger problem?
Yeah, I think that when you talk about the SPR, the Strategic Petroleum Reserve, there was several draws on that over the last several years in response to different crises that were developing, and that it will need to be refilled at some point in time. What worries me is that instead of filling it with $40 oil, you can be filling it with $100 oil. So it does present a cost to the economy that maybe wasn't always necessary to do it right now. But you also think about what that means longer term is that it just shows that we are still very much of a energy-dependent, fossil fuel-dependent economy. And you think about what are the sort of things that people are looking at right now to replace that, and that includes things like renewables. I think what it does do, Andre, it puts a greater focus on the need to replace fossil fuels with renewable energy resources. I know we've seen a lot of that, particularly here in Louisiana. There's various studies that show about wind energy, for example, over in Gulf of Mexico. That's exciting. That to me is going to be something that's going to be needed down the road. But this is not a 5, 10 year, 15, 20 year fix. This is going to take decades for that to happen.
Sure. Terry, right now, lately, the bond market, and when I say the bond market, I'm talking about treasuries. You've got the 2-year treasury, the 5-year treasury, and the 10-year treasury. The yield is over 3% right now. And just for our viewers, think of like a seesaw. In stocks, when a yield is up, that means more people are selling stocks, and when the yield goes down, that means more people are buying stocks. My question in the treasuries. Is that the same way? So let's say if a 2-year, a 5-year, and the 10-year treasuries are paying over 3% right now, are more people selling treasuries?
Yeah, so that's in response to what the Federal Reserve is doing, by increasing interest rates. And what the Federal Reserve does is they control the very short end of the curve, right? They control literally the next day yield on the whole Treasury curve as it's set up today. So when you're seeing yields increase today, that's because that people are either not buying or they're selling existing Treasuries, and that has the effect of raising rates all across the curve. An interesting perspective, though, Andre, around what's going on with the yield curve is the idea about yield curve inversion. I'm not sure if you've discussed this before, but that to me is very, a unique phenomenon right now, where you're getting actually more yield on a short term than you are on a longer term Treasury. And so, for example, if you were looking at a 2-year Treasury, you're getting about 3.25%. On a 10-year Treasury, you're getting about 3%. And you're thinking, why am I getting paid more for a shorter term Treasury than a longer term Treasury? It should be just the opposite. And typically in a normal market, that's how it works. What that tells me is that investors are anticipating that in the future, is that 10-year treasuries are going to actually be paying more than 2-year treasuries, because at some point in time, the Federal Reserve will become more accommodative and start doing interest rate policy. It's going to be a little bit more about loosening to make the economy a bit more, withstanding or the reaction to the lower rates, and therefore the economy start growing. So that's the odd thing about a yield curve inversion. That today it's traditionally been a sign of an upcoming recession, because the bond market's telling you that, I'm not willing to go ahead and I'm not willing to go ahead and extend buy out long-term treasury. I think in the future you're going to be worth more, so therefore I want to get paid more up front in the short-term rate.
Are you in the camp that when that inversion curve is where the 2-year pays more than the 10-year, that a recession will be forthcoming? Are you in that?
It's one of the indicators that we look to. And in the past, it's been a very good indicator of what is coming or what we may be in the middle of.
If you're just joining us, so happy to have Terry Dufresne. He is the head of investments, managing director at J.P. Morgan's Private Bank. We'll take a break. Be right back. So happy to have Terry Dufresne, head of investments at J.P. Morgan Private Bank, right here in New Orleans. Terry, before we left, we were talking about the bond market, and I just wanted to kind of finish up with that. When it comes to the bond market, does the stock market follow the bond market, or does the bond market follow the stock market, or do the two have any kind of correlation?
Depends on who you ask.
Okay.
If you're a bond trader or a stock trader.
Okay.
I think I've been doing this since 1986, and I will tell you that over the many years, I think that the bond market does a really nice job of forecasting what's going to happen. And when you see the bond market reacting to different news stories differently than you would expect it to do it, to me, it's a really good indication of where the economy and the market's heading. Let me give you an example of that. Is that there were 2 reports this year, both of them around inflation. And we had one report that was released in June regarding inflation in May, and we had another report that was released in August released in July regarding inflation in the month of June. And if you remember, the one that was in the May report that was released in June is that there was a surprise. It became much, much higher. It had an 8% handle that caught the market by surprise, and the 10-year Treasury traded up to 3.5%. And if you remember, that's also when the market bottomed, is when the market hit a low for this year. And then when you think about what happened the other time, is that when the market did release, or the Federal Reserve or Bureau of Economic Statistics did release the July numbers for the June numbers for inflation, that number came in at 9% plus. And the 10-year Treasury had just the opposite reaction. In fact, it traded down to 3%. And that was the beginning of this kind of mini bull rally we've seen, Andre. So I think that what happens is the bull market sort of anticipates where the economy is headed, not where it's been. And that's why I think it's a pretty good indicator of what the market's going to be doing into the future.
Let's say, for instance, okay, we're right now, we're almost basically in the beginning of September. So we've got just more months. We're in the second half of 2022. Let's say we do go into a recession, or we go into a recession either the latter part of this year or maybe early part of next year, whatever. You deal with a lot of high net wealth people. You deal with endowments and foundations and such. Where do you tell them to maybe put their money as a hedge or as a recession-proof type of investments?
Right. So one thing that I would think about is a couple things that you would on a go-forward basis where you should be looking to put money into. And we mentioned one of them earlier, and that was around renewables. Is that, in this part of the country, we all know how much we are, pay attention to and certainly owe a lot of our success to the fossil fuel business. It's been very, very good to the state of Louisiana, particularly, South Louisiana. But, at some point in time, we do need to look at, replacing the fossil fuels, and that would be with renewables. And that could take the form of solar, wind, anything of that nature. And I think that, longer term, when I'm advising clients, is that to start considering that for your part of your portfolio, because there is going to be more and more attention paid to that. The other thing I would mention to you is that thing about healthcare is that healthcare is going to be a very large and growing part of our economy because, let's face it, our demographics are getting older. Our people are aging out, and we got to take care of them. And you do that through healthcare, and you do that through any number of different ways of delivering that healthcare service, either through drugs, through therapy, through services. And I would think that healthcare stocks in particular would be something I would want to pay attention to my client portfolios. So think about certainly having energy in your portfolio, maybe looking a little bit more renewables in the portfolio, but healthcare is something that I would pay a lot of attention to. And in technology, Andre, we all know how important innovation has been to the success of this country, increasing our productivity. One thing we've learned with higher wage prices, higher labor costs, is that a lot of people I talk to who run private businesses, they've looked to ways to automate that role that maybe before would have been used a person. Now they're going to look about putting a machine there. And so the answer there is to think about how automation could step into that. So that would be sort of three different things that I would be looking at for not recession resistant, but also future investing for my client portfolios.
Do you have to have more of a stronger stomach with technology in this aspect? Because technology is a growth stock.
Yes.
And what normally gets hit first, like in the first half of this year, was technology. Now, back in late June and early July, throughout July, technology roared back.
Yes.
So as long as you've got a good time horizon and you can withstand the volatility, would that be like a preface that you would tell your clients?
Yeah, all things being equal, you depending upon your, like you say, your time horizon, your objectives, and what you're trying to do with the money, and as long as you've got long enough to be able to look at the cycle, let it play through, is that technology should be part of your portfolio, because that is where the growth is, and that's where the growth is going to be rewarded with higher multiples and also higher prices, and that's what technology represents as a bet on the future.
Terry, we're out of time, unfortunately, but I hope you come back, my friend.
I will. Thank you, Andre.
Thanks, Terry. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead at market information for next week. But first, what company successfully sold shares to the public on this day for the first time in 1919? Well, we've got the answer in a moment. Well, what company successfully sold shares on this day to the public for the first time in 1919? Coca-Cola. The initial public price was $40 a share. Now, successfully selling in 1919, I said because an earlier attempt to sell shares in Coca-Cola was actually tried in 1892, and it failed miserably. Well, next week on Wall Street Wrap-Up, we're going to be talking with your investment portfolio with the Chief Investment Officer of Crossmark Global Investments, Bob Dahl. Now, Bob has been in the business for over 40 years, and prior to being at Crossmark, he was the Chief Equity Strategist at BlackRock. Next week, the Chief Investment Officer of Crossmark Global, Bob Dahl. Well, as a reminder, we do repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that's our show for this Friday, August the 26th, 2022. I hope you enjoyed it. My thanks so much to Terry Dufresne from J.P. Morgan's Private Bank for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. So remember, follow us on all the social media, on Facebook, on YouTube, on Twitter, and WYES.org. So have a great weekend and a productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.